are diving deep into stock splits, or as deep as we can go given the 40 minutes of time that we have today. And we really want to talk to you about stock splits because we know that it's been some huge headlines about Tesla, about Apple. Some people are making money, some people are observing, looking to trying to figure out, okay, what's actually happening right now. And then you also have those who are the heavy hitters, who are CEOs of boards, who understand exactly what's going on in their company, and they are either selling the stock or they're buying more of it. So today we're going to hit on 4 key points, which are stock splits in general, historical stock splits, just to give you something to think about, and the impact of Apple's stock split, as well as positioning your buy before or after a stock split. And so one of the things that I'll tell you before I continue on is anything you hear today is not meant to be taken as investment advice. Brown Investors is not your fiduciary, which is a fancy term for we do not represent you and or invest for you. If you are interested in investment advice, then we suggest that you go to your financial advisor. Today's purpose is just for entertainment purposes only and should not be used as investment advice. We are hoping to have some great dialogue and conversation.
Yeah, and give you some insights for you to make your own decisions about what's best for you and your portfolio. So I guess kind of diving in, thinking about what stock splits really are, and giving you an overview. So as my mom mentioned, we want to equip you. So I'll let her get started on the actual what stock splits are, and then I'll talk to you guys about the different types of stock splits that you're going to see us talk through.
I guess that's my turn to explain this, right? She's giving me all the hard stuff. All right, so stock splits explained. A couple things here is most of you likely understand stock splits for what they are, but it's 2 types that we typically see in the market, which are reverse stock splits and conventional stock splits. What Apple did was was a conventional stock split. A reverse stock split, explained simply, is exactly what it says. It's basically the reverse of what you have. So as an example, AIG is a company that did a reverse stock split. If you guys want to get into the details, you can look it up. But essentially, this company was basically at risk for getting delisted. And so we want to bring this point up because sometimes as investors, we look at the fast money and possible ways to make some quick money. But at the end of the day, it's important to understand that you can make a decision that could completely lose all of your money. So AIG is one example of a company that did a reverse stock split. And there are marijuana companies out there, if you are currently investing in the cannabis industry, that's also done reverse stock splits, where if you'd invested in some of those companies, you could have completely lost your entire investment. So the net of it is that if you were holding, as an example, 1 share of AIG, and let's just say for simple terms, the stock share price was $100. A reverse stock split in this case means that you still own only 1 share, but you basically quadruple the share price. So the easiest way for me to explain is that you have 4 shares of AIG, and because they are doing a 4-to-1 reverse stock split, those 4 become 1, and that $100 becomes 1 share, but it's worth $400.
Yeah, and so
hoping that
I'm going to jump in because for the people that don't know what stock splits are in general, so like the name is kind of explanatory, but when you first hear buzzwords from investing, it's really easy to kind of not know where exactly to place your like focus. So in and of itself, right, a stock split is when a company divides their existing shares of stock into multiple new shares. So, right, like it can either be what my mom is describing, which is reverse, where they go from you go from having a lot of shares to a little bit of shares, or conventional, where you go from having a little bit of shares to more shares, a lot of shares, right? So in and of itself is literally just the multiplication, whether conventional or reverse, of the number of shares you have. So to her point, when reversing the stock splits, when we looked at a use case, right? A company example is AIG. When we hit the recession in 2008, what they did was do a reverse stock split because they were in danger of falling below the amount that you have to be for a company to trade in the stock market. So they were looking at falling below $1 a share. And obviously there's a lot of nuance to that, right? But they were in danger of being delisted, meaning they weren't going to be listed on the stock market for someone to easily go in, trade them. And so their decision as a company was, in order to save, one, public perception, and two, to save themselves from being delisted or removed from being able to trade them, they decided to do a reverse stock split to recover their share price. So I hope that gives a little bit of context.
Perfect example. And so for those of you who haven't attended previous webinars, Arianna typically checks me because sometimes I'm not explaining it in the simplest terms. And so it's good to have different spectrums of investing experience. But to move on to conventional stock splits, really want to just speak to the fact that what Apple has done and what Tesla has done is part of being a publicly traded company, which a conventional stock split is exactly as we have it in the description, which is you're reducing the number of shares held by each shareholder, and you are making it proportional to every other share that you hold. So in this case, Apple did will do a 4-to-1 stock split, which means that instead of reducing the number of shares, they're actually increasing the number of shares that each shareholder holds. So in this case, if you are currently holding Apple and you have 10 shares of Apple stock, you will, on Monday, August 31st, have 40 shares of Apple. It does not mean that you will then have 40 shares times the current share price, which Apple is currently trading at $500. Instead, you'll get more shares, but the share price will be divided by 4, which means that each share of Apple will be approximately $20. Check my math. I don't have a calculator on me. But the other piece that's really important is that companies that have done conventional stock splits include, but is not limited to, Federal Express, Tesla, as I've already mentioned, Trex, Old Dominion Freight Lines, as well as Apple. Today we'll take you through.
Oh no, I was just gonna add to what you were saying. I think to your point, right? Stock splits are common. I'm not saying that companies are doing it every month, but what I am saying is there is like a lot of news and headlines about Apple's stock split, but it's not something that's never happened. They've done it before, I think 4 or 5 times over the course of their existence. Correct me where I'm wrong, but somewhere along those lines. And the point is to say is that this isn't an abnormal thing to do. And so as an investor that approaches these sorts of events, you have to think about it in that way, and not do, have like irrational thoughts around buying and selling, etc. And so that we'll kind of get into that on the next slide as we talk about sort of irrational buying practices and that sort of thing.
Yes to the irrational buying. So I don't know how many of you have been spectators to what's been happening in the market, especially as it relates to the stock splits. But if you've been following Tesla, after they mentioned or made the announcement for the 5-to-1 stock split, their share price went over $2,000. Apple, when their stock split was announced, they went from $360 approximately to now $500. Yeah. And I know it's been trading a little bit above $500. And so we wanted to kind of talk you through that stock splits is only one part of the story. As investors, you have to be able to poke holes across everything before you decide to invest money, whether it's $100, $100,000, you have to make informed decisions. And so one of the two things that we want you to be aware of is that stock prices are a function of buyers and sellers. If you have a lot of buyers, this is basic supply and demand. If you have a lot of buyers, that means they're taking the shares off the table and there is not any more shares to purchase, which means the price is going to be all the way up here. If you have a bunch of sellers, that means you are now openly allowing more people to be able to buy it, which means the price is going to go down. And so here's what's happening right now. And we wanted to pull a couple of things for all of you because we are in agreement with one of the largest consulting firms out there, Big Three. And Bain Consulting Firm basically describes this type of buying when prices just shoot up, even though the company value hasn't changed, in that markets are built on the idea that investors are rational. However, when the markets start to behave irrationally, it's because those markets are feeding on irrational investors. So I would say, as a more experienced investor, watching the stock market, knowing that a stock split does not change the value of the company, in that the market is acting irrationally. So for Apple to go from $369 for one share to $500, that's irrational. However, knowing that the markets are reacting irrationally, Brown investors capitalize on that because we know that the markets have been acting irrationally, and we've been able to look at pretty nice profits across different portfolios, including our own personally. The other piece is the efficient market hypothesis, which basically says that all share prices are based on the asset prices. So the asset is basically the company that you're buying. And it's a direct implication that it is impossible to beat the market consistently if the market prices only reflect new information. And so this basically tells us that Apple, as an example, all investors did not have new information. When the new information came about the stock split, investors around the globe were excited about this, and because of that, they bought more. And as I mentioned, when you have more buyers, it can drive the price up. And that's exactly what we've seen with Apple, which on hindsight, it's still irrational market behavior because Apple's stock price or the company is still valued at $2 trillion. To quadruple that value would mean that Apple's worth like 10 trillion.
Yeah. And I guess like to that point, right? Like we'll get into whether or not you should position your buy before or after a stock split towards the end, which I'm sure is what most of you guys care about. But I will say this, right? When the market's acting irrationally, but you're a rational investor who understands the trends, you're able to capitalize off of these types of moments. And either you can do a short sale where you hold it for a couple of months, or you can keep it long term if you believe that it will continue to go up. Like those are the types of decision making like exercises you have to go through as you see the market fluctuating in irrational ways, right? So I think it's good to mark it down in your mind as something to think about as you see like crazy headlines causing people to buy a lot of a certain stock, right? Like how you react to the market, even if it's in alignment with this irrational buying practices, if you know when to sell, you're going to make a profit. So I think that's just something to think about.
Yeah, so I love the fact that you brought in short-term selling versus long-term selling, because I'm a long-term investor for certain companies. It's a handful that I personally love. And so it doesn't matter if the market goes up or down, I will continue to hold. Similarly, there's a different investing style for many people, but we wanted to particularly show all of you the Federal Express example, because we understand that there are some people who don't want to have anything to do with the stock market. They just want to leave their money and let it fly. And so this is one example, that's a perfect example, in that if you had purchased just 100 shares, if you were alive in 1978, which I wasn't alive. Arianna wasn't alive,
but yeah.
We're alive. The point is that in 1978, if you had 100 shares, FedEx did a 2-for-1 stock split in 78. They did one in 80, 83, 96, and 99. And the beauty of this is that you started out with 100 shares at $25.
Yeah.
Well, after the stock split, you then had 200 shares. In 1980, you now took your 200 shares to 400 shares. In 83, you took your 400 to 800. 96, you took that 800 to 1600.
Right. All while the share is still rising, right? All while the share price is still going up.
Exactly. And so by 1999, which is 20 years later, you now have 3,200 shares of Federal Express. You've done absolutely nothing. You haven't even looked at the stock market. You basically have been living your best life. And if you didn't have, you could have easily, as of today, had, just from pure math, $704,000, because Federal Express's stock is now at $220, but this does not calculate dividends and compounding interest. And so we'll talk about that on another webinar, but we know a lot of short-term investors leave a lot of money on the table when they don't allow the market to work for them, because compounding interest is a beautiful thing. And when a company also pays dividends, you're basically able to maximize your return on investment. So that's one example of a company stock split over time.
Yeah, and I think too, right? So the tagline here is, one, you can be a short or long-term investor and make money from stock splits. So you can hold it for as long as you want, or alternatively, you can short the stock, which is what I tend to like to do. Or the second headline is, right, you can continue to grow with more shares, with each share going up in price, trending on a upward path for a company you really believe in, and to not touch it at all. Like you don't have to, and you can look up and you'll have double, triple, quadruple what you had before, and your total amount will continue to go up as you gain a share in that company, right? So it's like the whole point is to say you can grow whether you short or long it, and you can also see that this isn't abnormal, that the companies have done it over time and they continue to do it, and we need to understand it in order to make the most out of that moment. So I think we can move on to sort of like the next. Mm-hmm.
Absolutely. So the next two examples are Trex and Old Dominion Freight Lines. Not sure if you've ever heard of these companies, but Trex is one of the leading companies in manufacturing wood and things that you would find in like new homes. And you can look them up online. But one of the things about Trex is that they've done two 2-for-1 splits. And you can see, if you look on the left of the trend line, that once the stock split, it obviously went down by half, but over time, it went right back up. And then again, they did another stock split, June 2018, it went down by half, and now it's more than double in less than a year and a half where it started. So the point in showing this particular example is that unlike Federal Express, actually, you can track. Trex actually came back to its previous trading share price. And so these are things you have to consider when it comes to calculating the valuation of a company, understanding current consumer trends and is the current price after it splits the true valuation. And so we have our own internal calculations and algorithms here, but we did want you to be aware of this. And when you look at Old Dominion Freight Lines, they actually have been on a serious roll when it comes to stock splits. But
and I was gonna say too, just to add to your point, I think a good point that you had is if you said something along the lines of if you believe the company's true valuation to be worth what it is after the stock split. So I think that there's something, you said something along those lines. I think that question is really important, right? Do you believe that the value of the company and the new share price is accurate? Or do you believe that it's somewhere closer to what it was before the stock split? So for Apple, for instance, do I believe that their true valuation, whatever number of shares they have is $90 or $120 per share? Or do I believe that it's closer to $500? Because if I believe the true value of the share is closer to $500 rather than $100, then in my mind, it's telling me that I should hold it until it goes back closer to that original number that they had before they split. Does that make sense?
I completely agree with you. And I saw some hands raised. We will address questions at the end. So if you guys can continue to ask questions, type them in the chat. And feel free to
pop them in the chat,
We will be happy to answer those. But I also wanted to elaborate on one of the things that Arianna just mentioned, which was if you believe your calculations are right, however you're getting your research, whether it's from us or some other source, you have to be confident in that decision and you have to hold it through. And so one of the things that we've seen some investors believe that they're at a certain valuation and they'll sell it because the market is volatile. And then a few months down the road, the price is actually starting to rise, and then that investor tries to get back in, but
I know
they're
someone
not really
does that.
Yeah, and so it's not a good investing style because you do a couple of things by getting in and out of the same stock that you could have actually allowed compounding interest to start to work towards your behalf. And if you make the decision to sell a company because you think you've kind of extracted as much value at the time that you can, then it's important to look at other companies that you're interested in investing in if this is your investing style. So again, I personally am a long investor on a hand select full of companies, and I'm a short investor on some other companies, similar to Arianna. But again, you have to make that decision for yourself.
And so when we talk really practically about how you find the fair market price, et cetera, right? To my mom's earlier point, we have a toolbox. We calculate it some other way. But for a beginner investor that's really just not certain on even how you begin, I would say you really probably need to have a ballpark range in your head, write it on a sticky and say, I'm getting out of this stock when it hits this price, or I'm getting out of this stock when it hits 20 to 30% growth. I'm getting out of this stock when it hits 10% growth, and stick to that. So to her point, you lose out on gaining money. You lose out on compounding returns. You lose out on certain benefits of the stock market by jumping in and out. And then to that first point that she mentioned around irrational buying, you miss out on so many opportunities by being an irrational investor and by choosing to get in and out based on what's happening in the market that day or that week or that month, right? You have to decide in your head, I'm going to hit a certain percentage of growth. I'm going to hit this certain share price, and you need to decide what's your upper bracket and what's your bottom bracket. Which one am I going to do?
Yeah, no, I totally agree. So now for the kind of big reveal with Apple. So
what everybody's been waiting for. We're going to dig into Apple. So you tell us what's happening with Apple. I want to know all about what's happening with Apple.
Let's be very clear. This is not investing advice. If you are looking for investing advice, you will have to go to your financial advisor. But so here's the deal. When Apple announced their stock split, Apple's valuation did not change. However, there were really, really excited investors who came and grabbed a lot of the Apple stock. And the stock price went from
Hold on 1 second. Can you guys hear us? I see that some people are struggling with hearing.
Audio?
Yeah.
I
I don't know. Okay. So I
hear
think, okay. So I think you, let's see. We'll try to get working on the audio for those that can't hear in the background. Sorry, go ahead.
I hope everyone can hear me. Now, am I loud? So just really wanted to say that when Apple announced their stock split, please be very clear that the valuation of the company did not change. And we know this because we're going to share something with you after we walk you through this, in that a 4-to-1 stock split essentially means that Apple is giving every single shareholder 3 more shares for every 1 that they hold, which will be equivalent to 4 shares per 1. And when that happens Monday, it'll basically be the share price divided by 4. So just like you guys just looked at the charts where Trex went up and they did a stock split and the price went straight down. Same thing for Federal Express. The price went up, stock split, price went down. If you are an Apple shareholder, this means that the current value in your portfolio for Apple will be the same.
Yeah.
But when you look at your percent changes, those changes will likely say 0, and it may say negative because the price will essentially have been cut by 4.
Yeah. Yeah.
If you are a long-term shareholder, investors who find the price to be attractive, they may buy more on August 31st because they want to hold more Apple shares. But that does not mean Apple shares will go from $120 back to $500 overnight.
Which is completely fair, right? Like I do think that we mentioned earlier, right? Like with FedEx, they're trending upwards. You would have had X number of dollars after Y number of years if you'd have just held it. I do think that's a good point, right? Like there is a time component to the amount of growth that you're going to see. So like, do you believe that Apple's going to grow quickly and you want to hold it because you can afford to hold it and wait? Or do you believe that it's going to take, if you think it's going to skyrocket tomorrow, that's probably not going to happen from my perspective. That's not going to happen. But what I will say is it does create another buying opportunity for investors who could not purchase or afford to purchase Apple before the stock split. So if you can't afford Apple at $400, $500, you don't have that in your portfolio, you're not willing to allocate that much money to 1 share of a stock, which is completely fair for investors that don't have that money or don't want to invest that much. Now Apple is making it more appealing for you to be able to buy a stock, right? They're making it a share of a stock. They're making it more appealing because now those that couldn't previously afford it can now afford it. So there is something to be said. It is a possibility that the stock might go up after that date because either people will continue to buy more and more because they believe that its current price following the split is below its fair market price, or the people that couldn't get into it previously and believe that it will go up and want to get into that growth spurt or trending upward growth will get in and can afford to get in now and will hold.
Exactly. So this example here is just an example of Apple stock split history, and similar to the math that we just did for Federal Express, in that you went from 100 shares to 3,200 shares and the share price was $25, and it's now for Federal Express $220 times 3,200 shares puts that investor close to $1 million or higher with dividends and compounding.
Right.
For Apple, they've done stock splits since 1985. So you could have started out with 100 shares and then had 200 shares after the stock split in 85. Then you had 400 shares in 2000. Then you had 800 shares in 2005. And then in 2015, you'll take that 800 times 7, which means you now have, can you do the math, Arianna?
500,
800 times 7 is 5,600 shares.
Yes, 5,600.
So 5,600 shares times $500, which is the current share price of Apple, is $2,800,000. So
yeah,
we wanted to break these down because, you know, in going through this exercise, and I know many of the people on the call may not be parents, but we get questions from parents asking, is it better to do a brokerage account versus a 529? And so if you think about a parent whose child, when they're first born, has a brokerage account, and let's just say mom or dad, they are convicted on Apple, they could buy 100 shares of Apple and say, hey, we're just gonna not look at it. We're gonna sit tight. And when our kid turns 18, that's gonna be their money. Now, if you had a parent who did that in 1985, I don't think they would have given that child $2.8 million. But the reality is that is what the portfolio.
Yeah. And I mean, as someone who doesn't have kids, cannot relate. What I will say is making those types of decisions for myself, I'm looking at the reason why we've gone through these use cases with FedEx, Old Dominion, freight lines, like the reason why we've gone through these use cases, one is to show you, yes, it's happened before. I think that's a fair read, right? But another is to say, you know, in 2014, Apple split its stock. They did a 7-to-1 or 7-for-1 stock split. So their share price had climbed almost up to, I believe, $700. It was like $650 that it had climbed to. And they did a stock split, you know, 6 years ago, and now they're doing another one. And it's like, I'm watching Apple stock continue to climb and climb and climb to the point where they're needing to split their stocks for a number of different reasons that we've talked through on this call. And so my first thought, if I didn't have Brown Investors, or I didn't have like our toolbox, or I didn't have all the like calculations that we do, my common sense like logic would just tell me if they're continuing to trend upward and they're continuing to grow in a way that's making their stock split, or their business owners make a decision to make their stock split and is continuing to go into the hundreds and hundreds of dollars, and now they're splitting and they're close to only $120 after this stock split, that tells me I believe they're probably going to grow. Like, this is me rolling the dice, right? Not Arianna the investor, but just a person with just like using my like logic. I'm thinking to myself, this is on sale. That's what's happening in my mind. I do think you can make those kind of like logical conclusions as an investor when you're first starting out. So I just like want to call that out because I don't want you guys to think that you have to have a specific number in your head. I think you can look at historical trends and look at like qualitative measures to really think about, is this a good buy for me or not?
Yeah, and so I think to kind of close this out before we go to Q&A, it really is, when do you buy a company if you know that they are splitting their stock? And so you have to decide, are you willing to be patient and allow the company to do its thing? Because if it's truly a great company, and not all companies with stock splits are
exactly,
because you invest in a company and that company may never come back just because it may not have the same strength as like an Apple or an Old Dominion. But you choose your investing style, and you have to kind of stay the course, because when you are undecided about your investing style for a particular company, you end up missing out on some really great returns.
Yeah, and it's like stock splits are a strategic decision on the part of the business owners that run that company. So it's like, if you're unsure, I would look into like previous news headlines, think about why they're deciding for that stock split. Is it because their share price is so high and they just believe that one, for public perception, or like for accessibility, for people to have more access to buying that stock, et cetera, that's why they're splitting? Or is it some other reason? Because I think if you consider like the strategic objectives behind the stock split, or go and do your research and try to find those, you'll realize whether or not it's a good buy before or after. And I also think just acknowledging the financial constraint that some people have, and not being able to afford Apple today, but being able to afford Apple tomorrow, like that also determines whether or not you should buy the stock before or after. So all really good considerations. And I think when you think about the before after, it's like, do you have enough money that you want to invest in it? Do you believe that the share price will go up or down following the stock split? And do you believe that it's a good company? And do you believe that it's worth, what price do you believe that it's worth, void of like the stock split happening? So just ignoring the stock split happening, do you believe, what number in your mind is attached to the value of that company? And put that in your mind, and then you decide, do you buy it before or after? I think she's frozen. But yeah, so I think those 4 things are probably the 4 or 5 things are the most important things to consider if you're thinking about before or after. And I think, I'm sure some of you guys want us to answer the question for you. While I can't answer the question on whether or not you should buy it before or after, what I can tell you, what I did for myself personally, I bought it before, and I also bought it before it became a big thing in the headlines that Apple stock was splitting. So that means when it was trading at around $300, I bought it, and now it's trading, it hit the $500 mark recently. So that tells you, depending on the number of shares I bought, which I'm not going to disclose, that I've at least almost doubled the amount of money that I have in Apple. What does that mean? That I'm going to keep it after it continues, or after the stock split? I don't know. It depends on like the growth rate. It depends on how fast I want to see my portfolio grow. It depends on what I see happening in the market. So those are all very important things to consider. And then the last thing I think we're going to get into is just around, what are the business owners in the company doing with regards to their buying and selling decisions for Apple? So I guess on the screen, you'll see a couple examples of insider trading, which that sounds really bad, but I'll let you go ahead.
Yeah, so a little technical difficulties. I got kicked off of Zoom. However, insider trading, by its technical term, is basically the idea of buying and selling from the board of directors, the CEO, and the chief officers of the company. And a free resource for all investors is, you can find insider trading on the SEC website. All you have to do is just type in the company ticker symbol. And the reason why this is important is because oftentimes if a company is, let's just say, buying a lot of shares, that's a form that board of directors views the share price as being undervalued. And then if a company is selling off the shares in large quantities, that's a signal typically that the share price is overvalued, which means that you as an investor may need to reconsider how much of a company's holdings that you have.